Jonathan, interesting piece. And I do wonder what you think it means. What are the big questions that you're asking right now?
Well, first of all, we're really bullish on the stock market overall, and tech shares in general are not the biggest beneficiaries of all this inflation. But when people say tech is doing well or not doing well, it all depends on how they define it, and there's no one definition. So if you look at small cap, a smaller cap tech, it's actually really cheap, and the earnings growth rates are expected to be much, much faster. But they've lagged meaningfully over the last 12 months, especially compared to what we're calling gamma. Those big five tech names, Google, Amazon, and the like. And if you look at the more broadly defined tech sector, you get a very different read. But mega cap tech is doing one thing. The average tech company has been more beaten up, cheap, and there might be some really good opportunities over the near term.
So I guess at least on the S&P side, is it a matter of semantics, meaning communication services versus technology, or is there a more material question there?
Well, I think that what the folks at S&P have done with their mix is 40% of the S&P right now is basically tech. And so by putting Amazon as a discretionary name, and by putting Google and Facebook as communication services names, to a certain extent, what they're really trying to do is kind of break up the tech sector. But here's the thing. If you're a tech investor, you look at this as one big pool. You want to look at it together. That's why we created this concept of Tech Plus, which is their official definition, and then adding all that other stuff that they've scattered about. But 40% of the S&P is technology. It's the dominant driving force for the overall S&P returns that you're going to get, over the next several years. And the S&P is just trying to stop one sector from being so overwhelmingly large. And it just makes it a little more difficult for tech investors to have like a single benchmark or way of looking at it.
Jonathan, this whole thing gets to one of my pet peeves, and yes, viewers, I apologize, there are many, about this idea that every company is a tech company. Every company is not a tech company. I'm not sure how you would define it, but in my sense of it is, does the company have unique IP, technology-wise, that gives customers a unique advantage, versus do they hire a bunch of software developers and do they use technology to run their business? Yeah, people can hire, I don't know, a whole bunch of custodial staff, but that doesn't make them a cleaning company. They can own a lot of buildings. That doesn't make them a real estate company. I mean, every company is not a tech company, right?
But first of all, let's just start with the easy one. Tesla, we don't think is a tech company. I mean, when we talk about tech, we're talking about digital technology, not innovative. I mean, they're an innovative company, but they're not a technology company. And more importantly, I mean, you have every single bank right now is saying that they're a technology company. Every industrial firm is saying, look what we're doing with big data. And that's great. They're users of technology. It's going to make them more efficient. That's why the tech companies are doing so well, because everyone's adopting it. But no, they're tech companies and they're not tech companies. And for the most part, these lines are really clear on the differences between the two. Well, ultimately, the question is, what do you sell to your customers? If you're selling a microchip, if you're selling a PC or a cell phone or a software code, you're a tech company. If you're selling auto parts and you happen to use technology in what you do, you're an auto parts company.